Hello, everybody, and welcome to the latest installment of the Butte County Library REACH program in the area of financial topics. And so today's topic is going to be on business taxes. Now, businesses file taxes, some businesses file taxes on different dates than individuals do. And so we wanted to make sure we address this early on in the year, well before you have to file, in case you have a business that has to file in March rather than April. I think a lot of people know that we have to file individual income tax returns for in April. Generally, it's April 15th, but actually this year it's April 18th. And so normally for individuals, we'd file in April, but for some businesses, they have to file in March. And so we wanted to address these topics in advance so that you have plenty of time to get all of your paperwork together and get everything done. So my name is Jacob Arbogast. I'm the director for the Center for Excellence in Finance at Chico State. And I also teach financial accounting classes at Chico State as well. And so I'm going to walk through some topics here for business taxes, but I first need to start with a little bit of a disclaimer. One, I am not a CPA. And the Financial Wellness Clinic does not, in normal operations, we do not provide tax information or tax advice, but we do have a little bit of knowledge in some of these areas, and so I am happy to cover those in this workshop. But generally, I would recommend, if you need tax advice, to talk to a qualified professional who does do that. Either a CPA would be a great example of a qualified professional. There's also a type of person who is called an enrolled agent, which would be a certification that someone could have to help people file their taxes. And also in Chico, we have the VITA program, which is the Volunteer Income Tax Assistance Program. And so if you make less than I want to say it's $58,000 a year. They can help you as well, and they have an application process to get involved with them. But that would be for individual taxes, and today we're going to talk about business taxes. And so these topics that we're going to cover today are not designed to be advice for you specifically. These are just general topics from the perspective of what I thought maybe most business owners, like small business owners in Chico, would want to know about. If you are a large business with, let's say, many employees and multiple millions in revenue, then I'm going to say this might not be the workshop for you, and you might want to hire a professional to help you with your tax needs. But I just want to kind of have that disclaimer up front. So this is not advice. This is just general educational information for the community. So the Butte County Library REACH program is available to help the community with all kinds of economic literacy and economic education topics. And so our series, through a partnership between the library and the Center for Excellence in Finance at Chico State, is to focus on personal finance related topics. But there are a lot of business owners in Chico, and so we wanted to make sure we kind of touched on those as well. And so future topics that we're going to cover will be on individual taxes, and then retirement planning. How much do I need to save? Insurance planning. What kinds of insurance do I need versus which ones can I kind of, not have? Maybe we'll also talk about topics like talking to your kids about money and how to kind of instill good money management habits early on, and many other topics. Each Friday, as we move forward, each Friday will be on a different topic. Okay, so let's start with kind of a background, and I'm going to approach this from the idea that, a lot of different people may see this video, and some will be coming from different areas in terms of their business and what knowledge they have. And so we'll start with kind of the foundation. So there are different kinds of businesses, and so we'll kind of walk through the different examples. A sole proprietor is what I would generally say would be a small business. It's generally, you're not going to have a very large company as a sole proprietor because there's not really a legal entity there. There's no protection to the individual who's running the business. And that's the concern, is if you're going to run a company and through, things that just happen every day, as part of running a business, sometimes you open yourself up to some liability. Either there's an accident or a mistake happens or something that it could be your fault or it could be not your fault, but you could end up being sued by somebody because of your business practices. And if you're a sole proprietor, they're going to sue you individually, and that's not a great thing. And so you don't want to be sued as a person. It would be more beneficial if you had a corporation set up or a business set up, so that if a liability event happens to where the lawsuit is going to be filed, that it gets filed against the business and not against you, where they might take your house or take a bunch of things that you own that you want to keep. And so being able to sue a business instead of an individual, one, it protects the person who was maybe wronged and is filing a lawsuit, because hopefully you'd have business insurance available to cover some of those things. But also it protects you as the business owner, because you don't want somebody to come and try to, if you lose a lawsuit, you don't want to have to sell off a lot of the property that you own in order to pay for that legal cost that came along with that. And so a sole proprietor is generally what you might think of as like an Etsy store, right? Somebody who just, does some business out of their garage or, their kitchen table or something like that. And there's not a real legal entity, right? There's no, there's an Etsy company, that's a big company, but all the little people inside who just sell things, from their house and put them in a box and ship them and that kind of stuff. Those are sole proprietors usually. Sometimes you might have a business that is an LLC that sells through Etsy as well. And you might see those on like an Amazon where people can sell products on Amazon as well. That would be an LLC, a limited liability company. So that's the next entity, is an LLC. And that's where you actually set up a business that is a separate entity from yourself. You would run it because you are the business owner, but an LLC is a legal organization. So where if somebody is to file a lawsuit against your business, they'll sue the LLC. And the LLC has its own assets and debts and equity and things. And so if the LLC loses the lawsuit, then the LLC is responsible for the costs. And if it's a major issue, let's say, some really big thing happens where it's $10 million in costs because of, some injury, like a personal injury thing could be huge. A wrongful death lawsuit could be huge. There's a lot of things that could happen where it could be very expensive. The LLC could go out of business because the legal costs are just too high. And then you as an individual would not have to sell your own property to try to raise these funds that frankly would just be, insurmountable for many people. An LLC also maybe wouldn't be able to raise those funds either and would go out of business. And, the company's gone and your livelihood as a company might be gone, but you can still keep the property that you own personally. And so LLC offers that protection. And that's why it's called limited liability company. It limits the amount of liability that you have as an individual to what you would be responsible for paying out of your own pocket, and puts that on the LLC. The LLC then will be responsible for any payments like that. And many businesses, when they interact with other businesses, businesses interact with each other, sometimes they require that their vendors be formed as a type of business entity like an LLC. I used to work for a company that did a lot of shows where we went to like concerts and events and trade shows and those kinds of things. And we went all over the country, and we'd have like a trade show booth and that kind of thing. And the companies who hosted the events, when they put on the event and invited companies to do shows like trade shows, they required that we had quite a bit of paperwork to show that we had business insurance, and we would have to have had a business in order to have business insurance. And so we were registered as an LLC. They wanted us to prove that we were going to withhold sales taxes so that we could pay our taxes, those kinds of things. And having an LLC allows us to be able to kind of streamline some of those processes. It'd be very difficult to deal with business taxes and sales taxes and all those kinds of things, and travel as a business and all of that. As a sole proprietor, it would have been much harder. So then the next entity type is called a C corporation. And that is the kind of business that actually most people, when they think of corporations, they think of a C corporation. And that would be your big names, the kind of household names of companies that you think of when you think of like companies that are on the stock market, or brands that you might see in big retail stores. Most of those would probably be from C corporations. And these are the kind of companies that might issue stock. If you're looking at the stock market, most of those companies are going to be C corporations, if not all of them. And they're kind of like the bigger players. But you can start a C corporation. I've started a C corporation before, and depending on your needs, a C corporation might be the best solution if you needed to issue stock, you needed to fundraise. A lot of times companies that are looking at like a venture capital type situation where they're maybe like a small tech company that they're trying to get major investors to get in on the ground floor kind of thing, you might want to register as a C corporation so that you can create shares and sell them and offer, similar to like what you might see on the TV show Shark Tank, right? Where someone comes in and says, I'll offer you so much percent of my company in exchange for $1 million or some other amount. A C corporation would make that pretty easy because you can say, here's how many shares there are, and of the total number of shares, 10% would be this much. And so there you go. And we make a transaction, you receive shares and they receive payment. That makes things pretty easy. So if you're the kind of company where you want to bring in investors to raise money, a C corporation makes a lot of sense. The next entity is called an S corporation, and that's kind of like a pass-through business. And so an S corporation is still a company, but the way that they do their taxes is that the S corporation will keep track of the incomes and expenses and everything, but then distribute that to each of the partners. Or I suppose you could have an S corporation with one person, but the way that I've done it in the past is we had multiple people involved with the S corporation. And then let's say the S corporation as a whole made, I'm going to make up a number, made $500 for the year, right? And then we have 5 members of the S corporation. Each of us would say that we earned, if we were all even partners, we each earned $100. In total, there was 500. And so then on our individual taxes, we would report that we had $100 in income from our like K1 statement from the S corporations, showing that we received an income because the S corporation made that income. It's also nice with an S corporation, if they have a loss, you can pass through some losses as well. So that would be, you'd have to be actively participating in this company, right? You're a partner in the company, but you can pass through that the company has a net loss, and that divides up amongst everybody. And a net loss from a business, although it doesn't sound great, it can be a tax deduction where you have a capital loss instead of a capital gain or something like that. Or in this case, it would be maybe like a dividend loss or something. I'm not sure how that would work, but you can have losses pass through as well. So the kind of business that you decide to create is really, it's a legal question as well as a financial question. And so I can speak to some of the financial pieces, but the legal part of it is above my pay grade. And so I'm not an attorney. And so I think it's a great idea to consult with an attorney who might be able to offer you some suggestions. The companies that I've worked with in the past where we had to decide whether or not we wanted to be a C or an S corporation, and I've done both with 2 different businesses. We had an attorney who advised us at one point to switch from being a C corporation to an S corporation. And we also had a CPA who worked with us. And so all of us combined got together and said, okay, how will this work if we switch from C corporation to S corporation? And how would that affect our, actually, I don't think we switched. I think what happened was we were just forming and we had done all the paperwork to form a C corporation. And then our attorney said, no, don't file that, file as S corp instead. And that was right when the company was being formed. But either way, the type of business you form will be dependent on your needs as a business, your tax needs, your business needs, your liability needs, all those kinds of things. And so there are different, depending on the kind of business you have, there are different tax due dates for when you file your taxes. And so S corporations and partnerships will have to file by March 15th of 2022. That's for this year. As of the date of me recording this video is in 2022. And you'll do that with an 1120S or a 1065. And I'll show you what those forms look like in just a minute. And then a C corporation and individuals for your individual taxes with your like 1040, you'll file on, for 2022, it's April 18th. Traditionally, it's April 15th of every year. But this year, I think April 15th, I forget, but maybe it falls on a Saturday or maybe it falls on a Friday, but a holiday. I can't remember exactly why, but it is moved this year to April 18th. And so generally it'll be the 15th. And if you're a C corporation, you would use an 1120, not the 1120S for an S corporation. You just use the regular 1120. They don't call it an 1120C, but that's how you think it. An 1120S is for S corps, and just a regular 1120 is for C corps. And so before you go to file your taxes, you're going to have some income and some expenses and some business transactions. And I assume if you're watching this video, you probably are at that point, so you kind of know what's going on. But there might be some things that you might want to consider. And depending on the size of your business, the kind of accounting that you do is going to make a difference. And so if you're a really small business, like the sole proprietorship, then we kind of just are going to have a cash basis, right? You're going to say, here's how much I sold, here's how much I brought in, I paid this amount for my costs. And that's what, generally people, when they're doing mental accounting and they're just kind of keeping track of how much they spent and how much they made, they're going to do it on a cash basis, because they're going to say, well, I spent this much, and then I received this much from customers. And so that's cash basis. Every time cash changes hands, you keep track of that's an income or an expense, and you want to keep track of all of your incomes and expenses, because if you have more expenses than you do income, you have a net loss, which you can deduct. Especially if you're a sole proprietorship, you can deduct that on your income, on your personal income taxes, and show that you didn't make money, you lost money, and so that your tax burden should be less. And that's one way to do it. But if you have a corporation with a separate legal entity, then you might want to do accrual-based accounting. And accrual-based accounting is, for one, it's required if you're like a publicly traded company. So think of, for example, Microsoft and Google and Amazon and these big names, right? They're going to do accrual accounting. They're required to. But what accrual does is it says, we're going to keep track of the cash, well, not actually the cash, but we're going to keep track of revenues and expenses based on when we committed to those things. And so it works really well for tax reasons, because what happens is, let's say you sign a contract, or a customer, we'll have two different examples here. A customer signs a contract with you because they're going to buy from you. And let's say it's something big, right? It's not just a retail product in a store. It's something that is going to require some planning and some, a big project or something like that. And so they sign a contract saying, yes, we're going to have this contract saying that we will buy so many thousands of dollars worth of your product or service. And we say, we'll do it, but they don't actually hand you a check or pay you cash right then on the spot. They sign the contract and they'll pay you later, right? That happens all the time. People have a contract and then you might pay some upfront and some later, or however that works for your business. But you have the contract signed. You can consider that a revenue. You say it's booked as revenue. We just have to do the cash transaction later. You have to also consider that if you're going to count that as a revenue, you're going to also have to count that as it's a deferred amount of money that's going to come in later, right? It's a liability where you have to provide that service at some point. You're required to provide that service now that you've signed that contract, but they're also required to pay you, right? And so you just have to think about that as well. And so you would consider the revenue having been booked when they sign the contract, even though you haven't actually received the money. And that might seem, because it might not seem as great, because you think, well, if I'm booking revenue and they haven't paid me yet, I have to pay taxes on revenue, but I don't actually have the money. So how am I going to pay the taxes, right? You're like, oh man. And yeah, okay, I get that kind of makes things sound not as good, but you can reverse the situation and it works the other way. Let's say you sign a contract saying that you are going to pay for something to a vendor. Some vendor is going to supply you with some things that you need for your goods or services that you provide. And so you sign a contract saying that you're going to buy this, but you haven't actually paid the cash yet. You can book that as an expense. And then later you can pay for it, maybe once it's delivered, or, some now, some later, or however that works for your business. Once that has happened, then you pay the actual cash to the vendor, and then you will have already booked that expense previously. And so now, with an expense, that's a tax deduction for a lot of expenses. Most expenses that we'll talk about are tax deductions. And so now you can reduce your taxes having not actually had to make that payment yet. You'll still have to pay it eventually, right? You've committed to it. You signed a contract, so you've committed to that payment, but maybe that payment doesn't have to happen for a little bit of time because of, shipping delays or something like that. So accrual-based accounting can be a little more tricky also, because it involves debits and credits. And in accounting world, that can be, burdensome and kind of intimidating for people who aren't really comfortable with accounting. And debits and credits are just our way of keeping track of accounts. Some accounts go up and some accounts go down. And if you use a software, an accounting software for your business, and there's a number of them, but QuickBooks is a pretty commonly known one. And if you use QuickBooks for your accounting, it's going to want to do debits and credits. I've used another product just so that I'm not plugging any one particular person. QuickBooks is one that's really known well. I've used another product called Wave. I think they're a Canadian company, but I'm not 100% sure. But they do the same kind of thing where they keep track of debits and credits in an accrual accounting sense of, how much are you spending and receiving and those kinds of things. And then later, once your year has completed, let's say you're on a regular calendar year, January 1st to December 31st, you can create a report for both QuickBooks and Wave and any of the other ones. There's a lot of different providers of accounting software. And so what you can do is at the end of the year, you can generate a report showing your income statement, your balance sheet, your total cash flows. You'll have cash flows from operations, cash flows from investing, cash flows from financing. You'll have all these different things going on. And you might want to be able to see those numbers so that you can keep track of the financials of your business, right? And so I recommend having an accounting software, unless you are like expert level in like Excel or other spreadsheet. I don't think that's even as good as having accounting software will alert you if there's some error that pops up, right? Your debits and credits don't match, or your balance sheet assets, liabilities, and equity aren't lining up right. Excel wouldn't be able to automatically notify you in those scenarios unless you designed it yourself. And so that's a lot more work than just getting a software that does it for you, right? So let's take a look at some of the forms that we're going to need if we're going to file our taxes as a business. So if you operate as an LLC, you can file as either a corporation that you can choose. There's an election that you can take to file either as a corporation like a C Corp would, or as what's called a disregarded entity. And a disregarded entity is just the IRS's language for saying that the LLC will pass through to you as an individual. And that's kind of the default. If you do nothing, you just file an LLC and then don't say anything about it, the IRS will just assume you're going to be a disregarded entity. And what happens is whatever money the LLC either makes or loses, it either has a profit or a loss, that will pass through to you, and then you will pay taxes on the income of the LLC on your own personal taxes. So let's say you don't have any other job and just running the LLC is your main business, right? You don't have there's no other forms of income or anything going on, just kind of a simple scenario where you're an LLC owner, or operator. And so that LLC has $100,000 in profit this year. So then you would pay taxes as if you earned $100,000 in profit. It would just pass through to you. Now you may have expenses as well. The word profit indicates that we've already removed the expenses, but if you had other expenses that you could take out from the income of the LLC, you could end up having a much lower personal income after expenses because of all the different expenses that come along with running a business. So disregarded entity is just where the cash flows will end up passing through to you as an individual. A corporation would have its own taxes it pays on its own from its own books. And it would then maybe, if you owned a corporation, you may pay yourself a salary, and that would work. You could be an employee of your own corporation. You'd be maybe the major owner, shareholder of the business. You could be the only shareholder of a business. A corporation doesn't have to have so many number of shareholders. It could just be you, one person. And then you could pay yourself a salary, and then that would be similar to if you had a W-2. You just pay yourself a salary and pay income tax, and then you'd also have to pay FICA taxes, which would be Social Security and Medicare. So that would have to happen as well. You'd have to have some, federal and state withholdings, and that's just more paperwork, but it's absolutely doable. And that's one way that a lot of people do their taxes is they have a corporation, they pay themselves a salary, they keep track of how much they pay themselves so that they can report correctly, and everything works out that way. And that's fine too. I think the biggest concern for a lot of people when they start doing the taxes for their business or for themselves, and a lot of people panic and they're like, it's too much work, it's too confusing. And I get it, 100%. I get it. It's very confusing. I talk about this stuff every day and it still sometimes can confuse me. Sometimes I have to pause and think, wait, okay, it goes this way and then it goes that way. And I get that, absolutely. I think what's the most important thing, if you're looking at operating a business or you're already operating a business, one of the most important things you can do is be organized. And so always have, my advice, you take it with a grain of salt because this is just me saying this, but my general advice is to have a separate bank account for the business so that you're not commingling your funds, and so that you can keep track of money coming in and money coming out. And also use an accounting software that can help you to know which things are revenues, which things are expenses, total up the total revenues and total expenses for the year. Or sometimes when I was running businesses, I would do quarterly reports so that I would know here's how much I made this quarter. And then I would do a much smaller version and a monthly report just so that I could keep track of what's going on each month. And so if you have all of your business financials in its own bank account, and the way that I did it, I even had it at a separate bank from my personal bank. So my personal bank account was with one bank, and then my business bank account was at a completely different bank. It was a completely different institution. And so that way there was never a chance of commingling. It was it was not really feasible for me to just transfer from the business account to my personal account or back and forth. I wouldn't have to worry about the tax implications of, did I pay myself a salary, or was that a distribution to an owner, or how does that all that work? I didn't have to think about it. I would just, if I paid myself, I would consider that income as just like a W-2. I would actually have a checkbook where I would write myself a check, and that would be my pay. And then I would record that on we have forms like a 941 where you'd record how much you paid and withheld in taxes to your employees. I would do all of that just like that, and I would pay myself as an employee. And that's one way to approach it. That's not the only way to approach it, but I think that's a good way to keep kind of financials in line and keep all of your paperwork in order and be very organized about it. So I put a link on here so that people who want to know a little more about the forms that you'd use and whether or not you want to be a disregarded entity as an LLC, you can go look at that. And this is the IRS website. And I have quite a few links to the IRS website so that you could read up more about it, more than what I could say in one presentation. And then you can see, maybe some of the details that they show you there. And so there's a form 8832, which is how you would file whether or not you want it to be disregarded or as a corporation. And remember, if you don't do anything, they consider you disregarded. So really, you'd only file 8832 if you wanted to be a corporation. And so that's the form that you'd use there. So here are some of the types of forms that you'd file depending on the kind of business you are. And so if you're a C corporation, or if you were an LLC and you used 8832 to file as a corporation, you'd file with an 1120. I'll open a link to that. And this is the 1120. So I have all of the forms open here. And so on the 1120, you can see, I'll zoom in a little. On the 1120, this is for 2021. And so what happens when you file taxes is you file for the year that's completed. And so in the year 2022, you will file for the year of 2021. So in 22, you file the paperwork to say what happened in 2021 to my business. And so you'll have your gross receipts, you'll have returns. So you can, if let's say you sold a bunch of money, or sold a bunch of products, but then a bunch of people maybe got the wrong product they didn't want, or it was defective in some way or something like that, you can reduce the amount of income you had because you had to return some of it to people. And so that's, anytime that you see the word gross, that usually means the initial amount. But net, you'll see a word net, if I can find here, net gain or loss. So net means you take away some of the costs or some of the negatives. So gross is usually all of the positives, and then net means gross with the negative pieces too. So for example, gross receipts would be if you sold, let's say you're a clothing retailer, you sold a lot of clothes and you had total sales of some amount of money. I'll just put $1,000 for now. You had $1,000 worth of sales of clothing, but then somebody brought back, a shirt because it was misprinted or something was wrong with it, and they didn't realize when they bought it, so they needed to bring it back. And so you issue a return, and so you return $20, and then your balance in this case would be $980, right? And so now you're saying, okay, here's the net revenues from the total of, I sold 1,000, but somebody returned 20, and now I continue my form. And we're not going to go every step of the line of every line for this whole form, but just point out some things that might be important. And at the end, let's say the rest of these were blank or something, so your total income ended up being 980 after all of that, and now that's your total income. You say, okay, well, my business made some income, and remember, we're on an 1120 form, which is for a C corporation or an LLC that files as a C corporation. And so what's going to happen is this business, U.S. corporation income tax return. So this business is going to have its own income and expenses and tax payments by itself. And this will not flow through to somebody else. But if I go over, I'm going to go look at a different form, which is very similar. It's 1120S. And the 1120S is for S corporations and partnerships, I guess you'd use it as well. But if you, actually a partnership will be on a 1065. So this will just be for S corporations, but S corporations have flow through to the owners. And so if you're an owner and your business, if I scroll down here and I can see the amount owed, and so how much you owe in taxes, or maybe you already paid, estimated payments earlier, and so you might be refunded some amount, but some amount of money is going to be sent to other people. So the owners who own the business are going to split however much is made by the company, right? And so these are all these two forms, the 1120 and 1120S, are very similar, but I want to look at some of the things that you might want to have deductions for. And so you can see on here, there's a lot of different ones, but some of the most common ones will be salaries. If you have employees, you're going to pay them salaries. You're going to have, if you've already paid some taxes on other things, you can deduct those. Any interest expense that you might have, if you're paying interest on debts, advertising costs. Depletion is if you use natural resources, and maybe in Northern California, we are, pretty big in agricultural areas. And so there might be a lot of businesses in this area that do have a depletion expense. And so it's going to be pretty common in agricultural or mining. I don't think there's I don't know, but I don't think there's very much mining going on in Chico or in Butte County, but that would be for those kinds of things. Pension plans or other types of retirement plans, employee benefits that you pay for your employees, those are all deductible expenses. So one of the things that I did when I used to be a consultant was I would help businesses put into place some benefit programs so that they would be able, they would be able to attract better, employees, more qualified employees, because they could say, hey, here's all the great benefits that we offer, but also they would have a tax deduction for that, for offering those benefits. And so it's a win-win for the business, other than the one negative is that they have to pay for it, but it ends up being much better for the company in the long run to be willing to pay for these things. And then you total up all your deductions. There's other deductions as well. Sometimes one of the things that I think individuals, if you're doing this for the first time, maybe you have a brand new business and you're not comfortable maybe how this works, and then sometimes you can say, well, there's other deductions that I could include, but they're not here. These are just some of the options available to me, but they're not everything, right? And so what I did for other deductions is they say attach a statement. And so what I did is I would create an Excel file where I would keep track of the different expenses that weren't listed here. And off the top of my head, I can't remember any of the really good ones, but I would show on there, what we spent them on, and then I'd have a little note of what it was for. You don't necessarily want to overshare information to the IRS if you don't have to, but I was very thorough with my math and my reasoning, so I knew I was in the right. And so I would always put a note like, here's what it's for, and here's how much we spent, and then it kind of just lets them know like, hey, I'm keeping like really detailed track of this, and then I would attach that with I would always file, this is pre-COVID, I would file paper statements and mail them in. And so I would attach literally just a printed off piece of paper. It doesn't have to be anything super formal. It just has to be accurate, where you say, here's how much I had in other deductions. And then that would go on there as well. And so you can see that's the 1120. And then you keep going, you'd sign. One of the biggest things is people always forget to sign. So sign your tax return. I've worked with a number of people in the financial wellness clinic here at Chico State where they have some minor tax issue, and they come in and say, hey, I don't know what's going on. I got this letter back from like the state of California or from the IRS saying that they've rejected my tax return. What's going on? And we look at it and I say, oh, you forgot to sign it. Like everything else here looks great, but you got to sign the form. And so that's one of the things as well. There's quite a bit of questions here to help you fill out the rest of it. And most of the time you can just kind of read through and understand what they're asking for. And you can go look at your financial records for the year, especially if you're using accounting software. It helps to go look at your records and say, oh, I can see that the total amount I spent on advertising for the year was X dollars. And so I can plug that in pretty easily, right? And so that's just something to consider as well, as if you're using software, you'll have that information available to you. So that's the 1120, the 1120S. The 1065 is very similar as well. It's for partnerships, but it's the same kind of thing, the same general idea, your sales, your returns, your total income, and then you can deduct a bunch of different things. And you can see almost all these deductions are the same idea, right? Setting up a retirement plan, and then some depreciation that you might have had. And so I'll talk in more detail about depreciation in just a minute. But that would be a major area of deductions in your income is from depreciation. And so same thing, depletion if you're an ag type business or a mining company, and then employee benefits, all those kinds of things. Then the form that I had mentioned earlier, this is 8832. This is if you are an LLC and you want to file for a different change of, for a change of how you are taxed, whether you're a disregarded entity, which is the normal situation, or a corporation, which is you can elect to be a corporation. And so you can see on here, it's it's very straightforward. It's check this box and then go to either step 2 or step 3, depending on yes or no. And basically what they're looking for is you can't change back and forth over and over and over again. You have to wait a certain amount of time before you can change. And so that's really what they're asking. Have you changed recently? And if you did, was it in the last 90 days? I think, I forget when. How recently have you changed? And then you can go through and then the type of entity that you are, and you just fill out the questions. And then depending on who owns the business, maybe it's this it's your own company by yourself, you just sign it and put that on there. And then some other minor things are on there as well. But the instructions are at the end. These are all fairly straightforward. You just have to sit down and read it. I know it can be a little confusing, a little daunting, because it's well, this one is 8 pages, so that could be a little much if you're like not into tax stuff, but it's not particularly challenging as long as you know what the purpose of it is. I think the hardest part for a lot of these is knowing what form to use in what situation, right? So 8832 is the form you'll use to change the type of tax, whether you're a C Corp or a disregarded entity tax filing for an LLC. If you're an LLC, you can choose using 8832. And then I also thought this would be a good idea to show this too, because a lot of companies, you're going to have maybe employees that you're paying. And so a 941 is your quarterly filings for when you have employees and you're going to pay them a wage. As an employee, you might have experienced in the past where you received a W-2 from your work. And the W-2 says, hey, over the course of the last year, we paid you this much money. We withheld this much for federal taxes. We withheld this much for Social Security and Medicare, and this much for state taxes. And you have a list. And sometimes it also will include things like this much was set for a retirement account, or this much was paid in like health expenses. There's a lot of things that could show up on a W-2 depending on the kind of employee you are and what what benefits that the business provides to you. And so a 941 is what you would use quarterly to say, hey, here's how much we paid our employees in total. And one of the nice things about the 941 quarterlies is when I was doing this for businesses, I was helping businesses do their taxes. I would keep them for the year. You should always keep them, but it was easy for me to just take the 4 quarters for that year, spread them out and say, add up each of the 4. And that's my total for the year. And it's really easy to just say, okay, quarter 1, 2, 3, and 4, add them all up. And that's what I had for the whole year. So when I go back to my 1120 and I go, how much did I pay in wages? Where it's wages, it's on here somewhere, whatever, salaries and wages. I would just take the 4 quarters that I filed on 941, add them up, and I'd be good to go because I know exactly how much I paid each quarter. And then there's a little bit you have to do. So if you are paying so you're paying wages, you have to withhold what's called FICA, which is Social Security and Medicare. And it's 6.2% for Social Security and 1.45% for Medicare, I believe. And so you'd have to withhold for those. And there's tables available where you can look up if you're paying your employee this much, how much to withhold for federal, withheld. And if they have depending on their W-4 form, an employee will file a W-4 saying withhold this much from my pay, so that it goes to the IRS ahead of time, because you don't want your employees to end up having a huge tax bill if they don't. I mean, let them decide for themselves, but generally most people don't want to have a huge tax bill come April, and so they maybe want to have more withheld from their paycheck, right? That kind of thing. And then there's just some little adjustments in those kinds of things, and most of the time you just read through the line of what they're asking for, and then you take each month of the quarter, right? A quarter is 3 months. And so there's 4 quarters in a year and 3 months for each of them. That's the whole 12 months. And then you'd add everything up and you'd be good to go. And then it's really just kind of going down the line and then sending it in. For the state of California, this is the IRS one, right? This is the federal return. For the state of California, when I did it, I haven't done it recently, but when I did it for businesses, there was an online portal where I would have the company is registered as an employer, and then on the portal I would enter in all of my employees and their social security numbers, and I would be able to show here's how much I paid each employee and when I paid them, and it would do the math and say, okay, you need to withhold this much for this person. And then that was actually pretty convenient because it's all online, right? So then I just have to worry about making sure I don't accidentally share my password with somebody, and then all the paperwork is going to be filed directly online. It's a little easier to keep track of. Okay, so we got all that. I'm going to go back to the PowerPoint. So we've kind of gone through the different forms that maybe we want to look at for filing. Some deductions that are going to be useful. I talked about a couple of them when we looked at those forms, but some that might be nice to consider. One is the qualified business income deduction. Sometimes it's called a 199A. And that would be if you are having flow through to your personal taxes. So a C Corp probably wouldn't be able to do this, but if you're doing like a disregarded LLC kind of thing, or if you have just a Schedule C where you were filing on your own personal taxes, and then you're like the Etsy store example I had before, where there's not a separate entity, you're just a sole proprietor, then you can deduct 20% of your business income regardless of whether you itemize or not. We'll have another workshop here where I talk about personal taxes, personal income tax. But generally, when you go to file your taxes, you can take either a standard deduction, which is the way that I think of a standard deduction is you kind of tell the IRS, listen, I'm not going to keep track of all the different costs I have, and you don't want to have to verify it. So let's just agree that I'll take the standard deduction, and I don't have to verify that I'm taking any particular costs, and the IRS doesn't have to do any extra work. Everyone just agrees the standard deduction is good. Or if you do keep track of your expenses and you do have a lot of different deductions, you don't have to do you don't have to do the standard deduction. You can itemize. And itemize says, here's a list of all my expenses, and I kept track of all of them, and there's a lot of them, and it's going to lower my tax burden quite a bit because I spent so much on things like, extreme healthcare expenses, or work-related expenses, or there's so many different things that might be deductible if you're going to itemize. Donations to charity would be an example. There's a lot of things on there that you might deduct. And so if you're doing that, well, qualified business income deduction allows you to deduct 20% of business income, whether or not you itemize. So you can take the standard deduction and 20% of the income off the top from your business. And that's a good one. That's a good one to have as well. But if you're having a lot of flow through in income from a sole proprietorship, you might want to include other deductions as well if you can. So that's just one. But it's for sole proprietors, S corps, partnerships. Also, it works for trusts and estates. So if you have a trust, or if it's for an estate, meaning somebody has an estate is when somebody passes away and then has some amount of funds, of assets and property and things that are left to someone else, and they have to distribute those things. That's what an estate is. And so this is just the IRS's article about the qualified business income deduction. And you can read more detail about it from the IRS as well. Another way to deduct income or have a deduction on your taxes is through funding retirement, especially if you have employees. This is a great, so I talked before about some of the companies that I had worked for would try to figure out ways that they can attract more qualified employees, and offering a retirement plan is a great way to do that, right? A 401k is one way to do that, but there's other options. I think a lot of people have heard of a 401k, and so when they think of retirement plan, that's the first thing they think of. But there are, depending on the kind of business you are, there are some other choices as well. And if you tell your prospective employees, hey, we have a retirement plan available, and we maybe match this much, or we contribute this much, you're going to attract better, more qualified, sorry, I shouldn't use the word better, but more qualified employees who are more excited to work for a company where there's a lot more benefit, right? Rather than somebody who maybe is working, a lot of hours for not a lot of pay. And, that's not really the best scenario for, a successful business or a successful employee. So being able to offer a 401k and funding a 401k for your employees is a great way to include deductions. And I showed on there that retirement plans and other employee benefits are deductible. So a 401k is one example. If you're a small business and want to offer retirement planning, a 401k might be a little too much of a lift for small businesses, but you can hire what's called a third-party administrator, and they can do the administration work of offering a 401k. And I've known large companies that have third-party administrators, even though they have maybe billions in revenue, they're still not experts at retirement. And so they say, listen, we're not going to bother trying to figure out how a 401k works. We're just going to hire a company that is an expert at it, and we'll just pay them the fee to manage it, right? And that's what whether or not you're like Apple and you have literally $1 trillion that you can throw at something. They said, we'll hire a 401k third-party administrator anyway. Or you're a small shop downtown that maybe you're just getting by, but you got enough where you might say, hey, I need to offer a 401k to my employees because I want to incentivize getting more qualified candidates in the door. A third-party administrator might be a great way to do that. And there actually are third-party TPAs, we call them TPAs. There are TPAs that exist in Chico that's the business in Chico that they do 401k administration. But there's also other companies outside of Butte County that you can hire as well. If you weren't going to go the 401k route, because that's kind of a hard ask for a small business, and a SEP IRA is a much more, I think, in my experience, it's been much more convenient to implement, because that can be opened through like a brokerage account. And I'll let you go look at that on your own if that's the way that you want to go. But what I've done in the past is opened a SEP IRA. We had a small number of employees. I haven't done it where you have maybe like 200 employees. That might be a little bit tricky to manage. But if you have maybe a small business, you have one owner for the company and like 5 people who work there total, a SEP IRA might work, but you have to contribute on behalf of your employees as well. And so there's a bunch of rules about how you do that, and you don't want to overcompensate the owner more than the employees. And so I highly recommend, if you're going to pick one of these, if you're going to go one of these routes, this is not this is not me advising that anyone should pick either one of these. I'm saying if you think that one of these solutions might be useful for you, go do some homework on it first. Don't take anything I say just as gospel. Just go look and see what solution might be the best for your business before you take any action. Oops. And so the next deduction that we might look at is depreciation. And the way depreciation works, and I think this is confusing for people who aren't maybe like financy, they don't think about taxes and finance and stuff that much. But the way depreciation works is if you have a major expense, and think of it like a big like capital expenditure, and that's what we call it, but something where you're going to use it for more than a year. You're going to use it for a long time. Say like you need to travel to make deliveries for your business, like you're like a bakery, and you're going to deliver things around town, and you need a vehicle like a van or a truck or something that you can deliver around town. You're going to buy that, and you're going to operate it for maybe 5, 6, 7, 10 years or something. You might operate it for a long time. You have a choice of whether you want to consider that an expense, and you can take all of that off in the first year. So if, let's say, you have a ton of income and you're going to buy a $40,000 truck, and so you say, hey, I can expense all of that and reduce my big income by $40,000 by taking that whole thing. That's one option. That's one choice you could do. The other choice is that you, instead of taking the whole $40,000 upfront as a deduction, you could take some of it upfront as a deduction and a little bit each year moving forward for a certain amount of time. And so for a vehicle, you might say, let's say 5 years, for example. For a vehicle, you're going to say, for the next 5 years, I'm going to take a certain amount of that value in deductions each year, so that maybe, let's say, for example, if I have a pen here, so I'm going to write some options here. So let's say option 1 is you deduct the entire 40,000, right? I'll put 40K. You deduct the entire 40,000. And actually, if I had, let's say I have 100,000 in income that year, and I spend 40,000 on a vehicle, that leaves me with 60,000 in income, assuming that, clearly there will be other things going on, but let's just, simplify it and say $60,000 in income that I need to pay taxes on. Well, then in year 2, right? This is year one. And then in year 2, I have another $100,000 in income, and I've already deducted the entire cost of that vehicle. And so I don't have I have 0,000 in deductions. And now I have to pay taxes on 100K. And so now, looking at the 2 years together, I've had to pay taxes on 60, and I've had to pay taxes on 100. My other option 2, is that in year 1, I have 100,000 in income, same thing. But instead of deducting the whole 40,000, let's say I divide it evenly over 5 years. And so 40,000 divided by 5 would be $8,000 per year. And so I deduct 8,000 this year. And in year 2, I still have another 100,000 in income in year 2. And I deduct another 8,000. And I can keep doing that all the way up to year 5 and deduct $8,000 each year, right? And so each year I'd be paying 92, sorry, let me fix that. 92,000, I'd be paying taxes on 92. And you might think, wait a minute, paying taxes on 60 and then on 100 or 92 every year for 5 years, which one's better? That is not an easy question to answer, which one's better, because it depends on the other things you have going on in your business. And you might think, well, that's not right. 92 isn't not, that's so close to 100 that it's almost not really worth it. But that's because of the numbers I picked, right? And so if it was 100,000 in cost and then I divided it, I could take off like 20,000 each year, and then I'd be paying taxes on 80 each time. And then depending on, you know, for corporations, tax brackets aren't as big a deal as individuals, but you know, I might be able to lower my total taxable income, and maybe I have a business that has flow through or something. There's a lot of different considerations here, but I wanted to just highlight the difference between depreciating 100% upfront, which now a lot of companies will start doing. They'll depreciate the entire thing up front. And so bonus depreciation, after we had a law passed in 2017 called the Tax Cuts and Jobs Act, and that allows for bonus depreciation, so you can take the whole thing up front. There's also another kind of depreciation, and I don't want to get too complex in this workshop, but there is another one where you would do, it's called double declining depreciation, where you'd spread it out over a number of years, but the very first year would be much larger. Actually, a bunch of the years would be larger than they would otherwise. And then you can depreciate using a mathematical formula. You can depreciate a little bit over time as well. And so I just wanted to kind of highlight that as an option. This isn't meant to give you, advice or plan just in the context of this workshop. This is just meant to give you some thoughts and some ideas that you can take with you when you go to do your taxes, or maybe go to talk to a CPA and ask, hey, I heard about this bonus depreciation, and as a CPA, can you tell me, how that would work for my business? And then your tax professional can say, yeah, I do know about bonus depreciation, and in your specific situation, it is a good idea or is not a good idea, and they'll be able to give you more details based on what's happening in your business. And so those are just some deductions to consider. Instead of taking too long of a time to cover every possible scenario, those are some things that we can look at. And I just wanted to, while we have this available, I wanted to just highlight the Butte County Reach program, so that if you go to Butte County's library, so buttecounty.net/BC library, and go to the Reach program, it's up here at the top, and then you can scroll down and see the calendar and open the calendar and see all the upcoming events as well. Or you can reach out to the Butte County Reach Library and see them. And just to also include the Financial Wellness Clinic as well. This is the program that I represent at Chico State. And so we offer financial planning services to the Chico community. And we provide, it's nonprofit, it's free, and it's for faculty, students, and staff at Chico State to help them with their personal finances as well. And so that is the end of the workshop, and I appreciate you all watching. If you have any questions, you can reach out to the Financial Wellness Clinic at financialwellness@csuchico.edu, and we try to answer them if we can. Thank you, and I will see you at the next workshop.